For most of the 20th century, Kodak was not just a company, it was a symbol, a giant, a financial empire that controlled the global photography industry. If you took a picture, chances were it was on Kodak film. If you walked into a camera store, Kodak was everywhere. The company didn't just sell products, it owned an entire market. At its peak, Kodak was worth over $30 billion. It employed more than 140,000 people worldwide. Its profit margins were massive. Its brand was legendary. Investors saw it as untouchable. Employees believed their jobs were secure for life, and the world believed Kodak would always exist. But behind that confidence, a silent threat was growing, and the most shocking part is this: Kodak actually invented the technology that would destroy it. In 1975, a young Kodak engineer built the first digital camera. It was bulky, it was slow, the image quality was terrible, but it worked, and it proved one thing clearly: the future of photography would not be film, it would be digital. Kodak's leadership saw the invention, they understood its potential, but they made a decision that would later become one of the most expensive mistakes in corporate history. They chose to hide it. Why? Because digital photography threatened Kodak's core business. Film was not just a product, film was the engine that printed money. Every roll sold led to processing fees. Every camera sold created years of future film sales. Kodak didn't make most of its money from cameras. It made money from consumables, from film, from chemicals, from paper. Digital photography would destroy that system. No film, no processing, no repeat purchases, just one device and infinite pictures. So instead of leading the digital revolution, Kodak tried to delay it. They feared cannibalizing their own profits. They believed digital would take too long to become mainstream. They assumed customers would always prefer physical photos. They chose protection over innovation. This decision locked Kodak into the past. Throughout the 1980s and 1990 seconds, competitors moved fast. Sony, Canon, Nikon, and new tech companies invested heavily in digital cameras. They improved sensors, they lowered prices, they built ecosystems. Meanwhile, Kodak stayed stuck in the film business. By the time Kodak finally started pushing digital products seriously, it was too late. Other companies had already captured market share. They owned the technology, they owned the distribution, they owned consumer trust. Kodak tried to pivot. They launched digital cameras. They invested billions into new technology. They bought startups. They shut down film factories. They laid off workers. But their business model was broken. The problem was not technology. Kodak actually had great digital engineers. The problem was money. Kodak's entire financial structure was built around film profits. Digital cameras had lower margins. Digital photos had no recurring revenue. The company was trying to replace a high-profit business with a low-profit one while still carrying massive old costs. It was like trying to run a modern startup while paying the rent of a dying factory empire. Revenue collapsed. Film sales fell faster than digital sales grew. Cash flow dried up. Debt increased. Share prices crashed. Investors panicked. Employees were laid off in waves. By the early 2000s, Kodak was bleeding money. Year after year, losses piled up. Leadership kept promising a turnaround, but every year the hole got deeper. Kodak also made another fatal mistake. Instead of reinventing itself as a tech company, it tried to remain a camera company. While the world moved to smartphones, Kodak focused on devices people no longer needed. When smartphones arrived, photography changed forever. The camera became an app, pictures became instant, sharing became social. Kodak was not part of that ecosystem. It had no platform, no software advantage, no user base. The final blow came when Kodak's patent strategy failed. The company owned thousands of digital imaging patents. They hoped selling them would save the business, but the patents sold for far less than expected. The cash injection was not enough. In 2012, Kodak filed for bankruptcy. A company that once dominated an entire industry collapsed. Hundreds of thousands of jobs were lost over the years. Retirements were destroyed. Pensions were reduced. Entire communities that depended on Kodak were financially shattered. And the most tragic part is this: Kodak did not fail because it lacked innovation. It failed because it was afraid of innovation. It failed because leadership chose short-term profits over long-term survival. It failed because protecting the old system felt safer than building a new one. It failed because they believed their legacy made them invincible. Kodak's downfall is not just a business story, it is a financial warning. It shows what happens when a company becomes addicted to its own cash flow, when it protects a dying business model, instead of building a future one, when fear controls strategy. The same pattern happens again and again in history. Big companies ignore change. They dismiss new technology. They delay transformation. They protect legacy profits. And then suddenly they collapse. Kodak's story matters because it is not unique. It is a blueprint for failure. It shows that being first does not matter. Being best does not matter. Only being adaptable matters. Kodak invented the future and then refused to live in it. That is why Kodak didn't just lose a market, it lost everything. And that is the real lesson behind the shocking downfall of Kodak.